It is my privilege now to be joined again by David Smith, senior analyst at the Morgan Report and regular contributor to MoneyMetals.com. David, it's always great to have you on with us. How are you?
Well, it's good to be back, Mike. I'm pretty excited about talking about the metals today.
Well, David, we've had some big moves in the metals so far this year. Gold stole the show during January and February with silver lagging a bit, but now silver is finally playing a little catch-up and has surged over the last week and recently made a 10-month high at over $16 an ounce. So what do you make of the market action so far this year, and what do you think is driving the advance in the metals?
I think it's very positive. It's fooled a lot of the people that are chartists. They look at these charts and they don't realize that after 5 years of decline of a cyclical bear market, that when things turn around, sometimes the rules change a little bit, and these points that they look at that are supposedly providing resistance to upside prices have been cut through like a knife through butter. And now, of course, if you look at the metals today, we're seeing a retrenchment in gold and silver, which is to be expected, and we may see back and forth here for a little while, but I think the tone of the market is different than I've noticed in the last 5 or 6 years. The buying comes in on the mining stocks is very powerful with a lot of volume, and when the better stocks decline, they do so slowly. And I think a person really needs to feel that we're, in all probability, looking at the resumption of the secular bull market in gold and silver, which began right after the 2001, 2002 area. And I believe that this leg is going to take us to new all-time nominal and real highs before it's finished in a few years.
Speaking of mining stocks, you, of course, follow the mining industry extremely closely and do a lot of analytical work along with David Morgan and the rest of the team there at the Morgan Report. Now, as we're talking here on Thursday morning, we're looking at gold bullion up roughly 16% for the year. And based on this week's advance, silver has pulled ahead slightly and now shows a gain of 17%. However, if you look at the GDX, the major gold mining index, it's up about 65% so far this year. The Huey has done even better and had a huge advance this past Monday. So why have the miners outperformed the bullion by such a wide margin?
Well, for one thing, they've been sold down on a proportionate basis much more severely. If you look at, say, the 2011 highs in gold and silver, gold has dropped, I think, about 42% from those prices, and silver's down around 70%. But the mining stocks, some of them are trading at 60 to 80-year lows on the TSXV, and so they have been sold down into a hole. And I could just give you a couple examples without mentioning names, but one stock I follow was 1150 in 2011, and it had one operating mine, and it now has two that will operate above $20 silver. I bought that stock for 27 cents a couple months ago, an 1150 stock. And there are many, many others the same way, almost across the board. A lot of the producers have dropped by 90%. So they were in such a deep hole that when they came out, it almost had to be vertical. And that's what we've seen so far with some of these up 300% and 400% from their lows of just 2 months ago.
A lot of people talk about whether it's the bullion that leads the mining stocks or the mining stocks that lead the bullion. What do you look for there in terms of confirming a breakout? What do you like to see?
Well, people have different opinions on this, but I think it's very positive that the mining stocks are being bid up in a way on big volume, and I think big money and institutional money is coming into these areas, especially the indices that you've mentioned. The metals themselves have specific chart points that people look at and they say, well, if it goes above that, that means such and such. And I think for silver, we need to see prices move up above $16 right now, but move up into the area of $18, $20 later this year. And those are very important pressure points. And I think when that happens and when those levels are attained and maintained, then we'll have further confirmation that the lows are in and that we're facing the possibility of a very long and lengthy bull market. And above $26, that's an incredibly important point from the chartist standpoint. If we get silver, or when we get silver above that point, that will really say something very important, because then you'll see a sustained rise beyond that if that level is attained, and I'd say about $14.50 on the gold. So those are two rough areas to look at. But the point being, I think if a person waits, but they don't have any physical metal now, and they wade into those areas, they're going to pay a lot more, obviously, but then there's the question of just how much is available. And you know, when this market was good and started, right up until 2011, there were questions about supply from time to time, especially in 2008, which was a kind of an artificial situation. But I think now we have a systemic issue of being able to find enough metal for the demand when it comes and increases the way it has been. So sooner rather than later, if a person intends to either establish a physical position or add to it.
Talk about your philosophy here with respect to mining stocks versus having the bullion itself, because you've actually written articles about this, including a great one last summer on moneymetals.com. Now, there certainly can be major investment upsides to owning the miners during bull markets, but you've noted that mining stocks and streaming companies should not be a substitute for owning the physical itself. Explain your thinking there.
That's really true, and I stand 100% behind what David Morgan has always said in his discussions in the Morgan Report, and that is get the physical first. So get what you need as an insurance policy and perhaps an investment piece of it before you start in the mining stocks, because they're a whole different creature. The mining stocks are a tool for trying to increase your wealth, but the gold and silver physical that you hold in your hand, that's an insurance piece that you would use if you needed to use it for barter, if you have a collapse of confidence in the paper promises that's in your wallet, if you have runaway inflation. And just there's so many uses for that physical metal. And so you want to have that and have it in a safe place, keep it a secret. Don't be telling people that you have it and your neighbors, this type of thing. And then if you want to go to a higher level of risk, then you can start investing in the mining stocks after you've researched them. And they tend to outperform the metal, but they have not done so for most of this bull market. But I think that's going to change. They potentially have a leverage of 2 or 3 times what you might make in the physical metal itself. But they are not a substitute for the metal, and in my view, they should not precede holding that metal. For one thing, if you wait around and try to get some metal, you may not be able to find any. And I think we're going to see that day coming down the line where it's extremely difficult to get the product that you want, with the premiums going higher, taking longer to have it delivered, and in some cases may not even be able to get it at all.
Furthering the point on supply here, copper is taking a major beating, and now we're reading stories coming out of China that they have a glut of copper supply due to the economic slowdown. Of course, silver is mined as a byproduct of copper often. I've read something like 20% of global silver supply comes from copper mines. So talk about this, because as we all know, and you just alluded to it, the supply-demand situation for silver does not allow for a lot of margin. So if copper mining is going to slow down significantly, what effect might that have on silver?
Well, by definition, there'll be less silver produced, since between 60 and 70% of silver is a byproduct of base metal supply, as you mentioned, copper, also lead and zinc. And there's another issue, too. There's actually a certain amount of silver that is we call it a byproduct, but is created when you're separating gold as well, too. I think that's another 6 or 7%. So the overwhelming majority of silver comes from those sources, with about 25% coming from pure silver miners, where the majority of their silver comes from actually mining the silver veins, and they still get quite a bit of lead and zinc in there with that as well too. But to me, that is an indicator that you watch, but you don't try to make your trading decisions based on it. It's a lagging indicator. It's just something that adds fuel to the supply question fire if you see a sustained reduction in the production of copper and base metals.
Platinum and palladium have also done well in 2016, although they're both lagging behind the money metals, gold and silver. Both of the PGMs are up in the neighborhood of 11 to 12% this year, but it does look like they're having a hard time sustaining upside momentum over the last month or so. So why are platinum and palladium lagging? Is it economic concerns pointing to less industrial demand? What is it?
I think a lot of that is the concern with the global slowdown in the economies, because platinum and palladium, they have a certain investment quotient and a certain jewelry quotient and a certain medicinal uses, but by and large, they are industrial metals. And as you know, platinum and palladium, the biggest uses for those two metals are in catalytic converters for automobiles and trucks. So when we see sustained strength in the economies going forward, that will tend to turn things around. Then also there's the question of the supply coming in. For example, just a couple days ago in Zimbabwe, there was an internal memo that showed that the largest platinum producer there might have structured their payments of the money for their salaries so that they would avoid Zimbabwean taxes. And if that is the case, the government could come down pretty heavily on them and maybe even nationalize the company, and they're one of the major producers of platinum. So these things all come together in the mix. I think you'll see sustained higher platinum and palladium prices as we move more into an inflationary environment down the line. But I believe that they will lag gold and silver at this point, because gold and silver are functioning as money now. And if I could make one point, Mike, here on gold and silver, I think is extremely important for people to understand. I've noticed a lot of hand-wringing the last couple of weeks about, gold has been strong and silver has not been as strong. Well, here's the thing. Adam Hamilton and others have shown, that, and David Morgan as well, too, that there's about a 90% correlation in the direction of gold and silver over time. And so, in other words, if gold is going up over time, silver will as well, too. But they do not move in lockstep on a day-to-day basis. And what I remember from my trading, when I was trading futures in the 1970s up into the 1980 bull market top, I would see, and this especially in the latter days, I would see gold just moving higher day after day and silver just absolutely sitting there. And then all of a sudden, it was like a tag team. All of a sudden, silver would just break out and start moving, and it would go higher day after day, and gold would just be going sideways. So people should not be concerned about this if they're not moving in tandem on a day-to-day basis, because that's just not the way they operate. And I've noticed the same thing here in this beginning of this new bull market phase, and I think people should kind of keep that in mind. Now, if they're both moving down, sustained, then you don't want to see that. But at the same token, don't worry if just one is moving up in a given week and the other is pretty quiet.
Yeah, prime example here. This year we saw, as I mentioned earlier, gold doing quite well in January and February, silver lagging a bit. Now this past week we get a big silver surge. Gold is just kind of going sideways, and lo and behold, they're now up about the same percentage for the year, 16-17%, but on a week-to-week or day-to-day basis, they are trading quite differently and have over the first 3.5 months of the year. One of those potential rocket fuel situations for higher metal prices, of course, would be the central bank policy decisions. We've seen negative interest rates in Europe. They've maybe talked about that a little bit here in the States. Obviously, they've been reluctant to raise beyond the 1/4 of a point that we saw back in December. That's, I think, driven a lot of the metals advance. What are your thoughts there? Are we going to continue to see very accommodative interest rate policy, very inflationary monetary policy coming out from these central banks?
Well, my read on this, Mike, is that the central banks and also the big banks in these different countries are running out of options. They continue to do things that haven't been working very well, and they don't have an option of doing things that will work well because they don't have that correct mindset, at least yet. The old story of what Winston Churchill said about Americans, they always do the right thing after they've done everything else first. And I think that's what the central banks are in the process of doing. They're trying to go down, and they now have, in some cases, negative interest rates where you pay the bank to store your money or you pay the bank to buy a bond. I mean, that's insane. And if you have negative interest rates, the signals that interest rates give off as to the viability of a project or an investment are no longer there. The customer can't make an intelligent decision. So I think we're going to see them continue to push things down. And what they're trying to do is to stimulate the people to buy and to make purchases and get the velocity of money up. But people aren't doing that. And you look at Japan, where they push things down to an incredible extent. And what they've done, the only thing they've stimulated in Japan is for people to buy record numbers of safes so they can store their money at home. And so they have a huge demand for 100,000 yen notes, which is about $1,000 in our money. But they're not going out and buying things. So until the velocity comes up, they're going to have a deflationary situation, which is the greatest fear of central banks, rather than an inflation. Believe it or not, they want inflation, which by definition takes away the purchasing power that you and I have year after year.
We got news today that Deutsche Bank settled a class action lawsuit from investors regarding rigging the silver fix price. Turns out the bank was cheating its own customers by colluding with the other participants fixing to manipulate the price. And it sounds like Deutsche Bank is promising to hand over the goods, emails, and electronic chats and so forth from the other banks who participated. Now, lots of metals investors have almost given up on the idea that any of these criminal bankers would ever really be held to account. The CFTC spent, 5 years investigating these issues and ultimately failed to prosecute anyone. To us, the story is just further confirmation that price discovery in precious metals is a flawed, broken, and corrupt process. What is your take on this story and the issue of price discovery generally? Any chance metals producers and investors can escape this flawed system anytime soon?
I think Mr. Market is exerting his muscle in these areas. And this doesn't surprise me at all what Deutsche Bank has admitted to. This is just soup of the day. You can go back and you can look at all these other banks have done the same type of a thing. Goldman Sachs, just a couple of days ago, agreed to pay something like $5 billion for misleading customers about the viability of certain mortgage vehicles. The banks have admitted in the UK that they rigged the LIBOR rate, which is the interbank rate that banks charge each other. I mean, if there's something that they can rig, they'll do it. All markets are rigged. I think Chris Powell said this, there are no markets, just manipulations. It's really true. And you don't have to be a cynic to think that they're doing the same thing in gold and silver. They're just after the unlimited amount of money that they can fleece the public for, and so far they've gotten away with it. But these events like you just mentioned and the power of the Internet to breathe light into the dark recesses that these bankers and investment banks operate in are showing that more and more it's getting difficult to hide your misdeeds. And I think that's ultimately will bring down the house of cards when people realize just what's going on and they say, you know what, we have to have this thing cleaned up and not just pass some more laws that insulate the biggest players and take money from the public in order to take care of their misdeeds. There's going to be an insurrection on the part of the consumer and the investment people, and at some point, and gold and silver will be the vehicles that allow that to happen because they're real money, and paper money never is able to stand up against the truth and the light that real money bring to the investment areas. David Morgan points out, and he's done a lot of research on this, there has not been a single paper unit that has survived the test of time. They've always gone to their intrinsic value of zero, and people go, oh, but the U.S. dollar in my pocket, I can go down and I can buy a car today. You know what? I bought a Firebird in 1979 for $4,250, and that same car today, not produced even nearly as well, would probably cost me $40,000. So tell me about how much my money has lost in that time. The U.S. dollar is worth 2 cents of purchasing power compared to what it was in 1913 when the Federal Reserve was put together, and go back and compare that with the purchasing power of gold and silver, and I think the people that have some will be pleasantly surprised.
Yeah, excellent point. That's really the crux of owning precious metals, owning gold and silver. It's preserving that purchasing power, a way to sort of have some insurance against your paper money. And those examples are fantastic in terms of what an ounce of silver or ounce of gold would buy today versus 100 years ago, and then compare that to how little your paper money buys today versus that same time period. Well, as we begin to close, what do you envision for the metals, the balance of the year here, David? We did see strong starts to both 2014 and 2015, only to see the metals fizzle off as we went throughout the year and they ended lower. So what do you see ahead in the last few quarters of 2016 for gold and silver?
I think we're going to see big swings in the precious metals and the mining stock prices throughout this year. What I want to see are the classic definition of a bull market, which is higher highs and higher lows. So on any reactions that we get, one of which we're looking at now as you and I are talking, I want to see some of those lows holding, and then I want to see new buying coming in on volume. So you have low volume on the way down and higher volume on the way up. And then over time, stair-stepping up, even as people worry that these signals are not going to hold and get us through the year. I think it's very possible that we'll see silver in the mid-20s by the end of the year, and gold perhaps as high as 1,400 or so. It's really difficult to predict price and time, and very few people do it wisely, that they don't do it. But I think this is going to be the base-building, strength-building year where people start getting back the money they've given up before if they held the mining stocks over the last 5 years. And I think it's an opportunity. I think it'll be the last really good opportunity to add to your precious metals holdings on a physical basis if you don't have them or if you don't have enough at prices that, are reasonable in relationship to the premiums and the demand. And I think 2017 is going to really show us that the supply situation has become quite tenuous, and if any new demand comes into the market on the part of the individual investor or the institutional investor, which I think they'll do it in both cases, I think you're going to find a real difficult time getting the metal that you want for a fair price. So going forward, I'm very optimistic about the market. I think the bear market is over, the cyclical one. I think the secular one is reasserting itself, and we're going to have several, 3, 4, 5, 6 very good years ahead for people that hold precious metals and mining stocks.
Yeah, we've got obviously a lot of constructive things happening here with the prices, as we talked about offline. A lot of black swans seem to be circling around in these markets, and if any one of those seems to happen, then obviously we could have a huge spike in demand. Supply issues could rear their head again, and we'll see what happens from there. It figures to be kind of a bullish setup. Well, thanks very much for your time and your excellent insights as usual, David. As always, I'm looking forward to your next article for moneymetals.com, which I believe is coming out very soon. That's always great stuff. And we certainly look forward to talking with you again real soon. Hope you enjoy your weekend, David, and thanks for joining us.
Very good, Mike. I always enjoy speaking with you and your audience.
Well, that will do it for this week. To check out David's insightful columns, just go to the news section on moneymetals.com or type in David Smith in the search box, and you'll get links to all of his work. Be sure to check that out. Thanks again to David Smith, senior analyst at the Morgan Report and moneymetals.com columnist. Check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.